Good evening, or good evening. After everybody. Yeah. I will call the meeting to order at 3:02. As a reminder, if you make motions, please give your name so that everybody. Board communications, I have none. Anybody else have? Finance director.
Morrison. So for this quarter, our expenditures are $1.2 million. Those are pretty much in line with where they were last year. Majority is related to monthly pension plans and the return of contributions. Typically less, which is nice. On the revenue side, the expenditures are actually exceeding revenues at this time. The reason for that is we have our annual contribution pension fund, typically done by September 30th, but this year it was other points I wanted to just touch base on the gain and loss. Much less realized loss of $1,000. So that as dividend income is higher than we had. So leading to higher interest rates and better economic upturn.
The August 10th, 2023 minutes. Yeah.
Freeman for a moment.
Motion by Freeman, second by Burbank to approve the August 10th, 2023 meeting minutes. Any discussion? Not all those in favor say aye.
Aye.
Authorization of payments. Usually we take this as one vote. Foundation.
And second.
It probably doesn't matter on the agenda. It's 2024.
Yeah, after this. Okay. Any other discussion? Not all in favor, say aye. Aye.
Basically, he's minding the store. Rich.
Yeah. You're acting deputy chief, Rich from Higher Chief Archie. Yeah. SCI investments. Yeah.
Hi, good afternoon, everybody. Can you hear me okay?
Yes.
Okay, great. Would you like me to share?
Go ahead.
Okay. One second here. Somehow I closed the presentation. So while I'm opening that up, I'll just start off with a fun fact here. So for the third quarter, GDP growth was actually phenomenal. It was up 4.9% versus the estimates of around 2.1%. And what I thought was interesting was if you combine Taylor Swift, Beyonce, the Oppenheimer movie, and the Barbie movie, that represented $8.5 billion of that GDP. So that was just over 0.5% of that 4.9% GDP. So just pretty incredible numbers. So, what that tells us is, people were out in droves. They were enjoying entertainment again, movies. Unfortunately, summer months are over now, so we're not going to see the benefit of that for the fourth quarter, and we do expect lower returns in the lower GDP growth in the fourth quarter as a whole. So I'm not going to spend a lot of time here because Mark is in the office with you and he has an economic overview as well. So I'm going to go through the front end relatively quick once I get this up again here, which is just about a second. And I'll go through this pretty quickly. I won't hit every single point, and then we'll just get into performance so he can go through some of his market, capital market updates. Okay, here we go. Just let me know if you can see that okay.
Yes.
Okay, I'll put it in slideshow mode. Just let me know if the pages are moving also, because sometimes they get hung up. Okay, so we mentioned GDP growth, pretty phenomenal. We had the Fed raise rates 11 times. They paused the last two meetings. We do anticipate the Fed is essentially kind of really data dependent right now. It wouldn't surprise us to see one more rate hike, but most of the language coming out from the last meeting minutes and from other Fed officials, they're going to pause here for a while. So that's kind of good news for the markets, right? I won't spend a lot of time there, but we've been waiting for that. We've been waiting for that when's the end of that tightening cycle, and I think we're very, very close to that, if not there. So we'll see how the data comes out for the economy over the next several months as we move forward. But for the quarter, it was a down quarter, mostly September and October. The first 3 quarters of October were down as well. This is only through September, so you can see we had a pretty negative quarter across the board. All risk assets sold off. But in addition to that, we had risk assets sell off, which you would think would help fixed income. We had fixed income sell off pretty significantly. And that's exactly what we saw last year happen, right? We saw equities and fixed income sell off because rates are rising. Very similar to what happened in the third quarter. Things have picked up the last couple of weeks, but all in all, it was a very negative quarter across the board. So the longer duration bonds you had, the worse you did. If you were a short duration, which some moves we made in the portfolio to shorten duration actually really benefited, and I'll talk about that. But all in all, the only real positives were high yield bonds, treasury inflation bonds, and commodities as a whole for the quarter. So page 6, looking at value versus growth in the bottom left-hand corner, it was a growth-driven market. Magnificent 7 stocks, so high-flying growth stocks were doing really well, where value was left behind when you look back on a one-year basis. For the quarter, they were pretty even. So we did see some benefits, especially in September, for more value-oriented stocks. And I'll talk about that once we get to performance as well. And then you can see the sectors here. Technology was the big leader last quarter. It's moved to the right of this chart. So this quarter was energy, communications, and financials were the leaders for the quarter. International stocks, just a few highlights here. When you look back on a one-year basis, developed international has actually outpaced the US, so we haven't seen that for quite some time. But that was also beneficial to the portfolio changes we made because we had a very large bias to the US in the portfolio, and we moved a little bit more into international to take advantage of those valuations. So that played out nicely when you look back over the last year. Japan has done very well, mainly because that's really cyclical. If you think of Japan and some of the other Asian countries, they're really behind in COVID. So their economy is really starting to flourish from the reopenings. US went through that about a year ago. So now we're seeing the benefits in Japan in very low inflationary environment. So much different environment than most of the globe where we see tightening cycles going on and inflation. Japan's the opposite. It had a very good one-year number. And frankly, even a quarter, it's negative, but it's less negative than the rest of them. Fixed income rates have been all over the place, extremely volatile, as I showed you on the first page. The 10-year has moved more recently from just over 5% back down to about 4.55%, all within a couple of days. So that just really shows the volatility within fixed income. But again, I think we're coming to the end of this tightening cycle, so we should start to see things calm down a little bit. And quite frankly, at the end of next year, we might see some rate cuts, and that might be priced in for the market. SEI does have a viewpoint that we could see kind of a short-term recession next year as a result of this tightening cycle. A lot of that has to do with a lot of factors are happening because of rates rising, right? We're seeing people with adjustable rate mortgages, their rates are going up. Credit card rates are going up. And credit card spending has increased. So consumer spending was a big part of the third quarter, but a lot of that was used on credit cards. So that's a problem because at higher interest rates on the credit cards, it's going to be harder and harder for them to pay that money back. So those are all things we think are going to slow down the consumer from spending as we move forward. And we should start to see GDP go down next quarter and the following quarter. But we do believe we could have some sort of rebound towards the latter part of next year. Okay, the next 3 slides, please read through these at your leisure. I just wanted to throw some interesting statistics out here about what's going on. I'm not going to go through these in depth. And let's get right into the performance. Okay, so year to date through the end of September, the plan was up 5.44% net of fees, just in line with the index, just slightly below the fee there. Just keep in mind, that's everything, that fee incorporates everything we do, our OCIO, all the other IPS reviews of Mark and those guys. So it's not just investment management fees, it's everything, it's the whole bundled solution. So we did, we're neck and neck net of fees. It's a pretty good return considering what happened in September. I'd assume that we're down a little bit in October, but we rebounded in the latter part of October and November. So the plan was at 131,760, $131.76 million. As of yesterday, it was up to $132 million. So we're up. We had a downturn the first 3 parts of October, first three weeks of October, but then we got some of that back just the last 2 weeks. So we're a little bit ahead since the end of September. So again, that was $132.018 million as of yesterday. As far as performance, I mean, in line with expectations, I'll let Mark spend time on this when he goes through his review of the funds. But what I wanted to focus on mainly was a couple of points here. One, when you look at the US equity factor base, why that looks like it's underperforming pretty significantly there, that's a value-oriented fund. It's much more defensive in nature. It's focused on strong fundamental companies. So it doesn't have as much of those high-flying tech stocks, which represent about 26% of the S&P 500 right now, which is why that underperformed. It also has small cap and mid cap in it as well. So, and then moving forward here, we added a little bit more to the International Index Fund for Fidelity, and you can see what that's done on a year-to-date basis. It has underperformed on a year-to-date basis, but outperformed on a one-year basis. And here's where really you can see the yield movement. So overall, your total fixed income portfolio was up 1.21%, but that was driven down by core fixed income. Has a longer duration of around 6.5. So you're going to expect negative returns when the 10-year yield goes up over 5% during the year. You're going to see negative returns as a result of that. So we moved money, a pretty considerable amount of money into limited duration, and you can see what that did. It was actually up 2.6% versus where it was, which was down minus 0.67%. So that's a pretty healthy delta that we got from shortening duration of the portfolio, and that's the exact reason why we did that move and made that recommendation to the board. And then high yield bonds, emerging market debt on a year-to-date basis both did pretty well. High yield did a little bit better, up 7.8, and emerging market debt was up 4.78. Real estate's essentially flat for the on a year-to-date basis. Any questions around performance or the economy? Anything else?
No, thank you. Appreciate it.
Thanks, Patrick.
Thank you. Okay, I'll stop share here. Here we go.
Okay, thank you very much. Moving on to stage 2. Thank you for being here in person.
It's nice to be here. Talking to John and Mark earlier, it's probably make the trip this time, but see everybody in person. I'm going to hit upon a couple points on the economy. I think Pat and I generally we have similar decks and kind of similar news there. So I'll just hit upon a couple, and then our real major role is to oversee the investments that Pat uses to build the portfolios and give you analysis of that. And to be honest, everything's looking good from our standpoint, but I'll give you an update there. Pat talked a lot about GDP. How surprising it was is basically all of us Americans spending money, and that makes up about 2/3 of the economy in the U.S. Job market surprisingly staying strong, spending money, but we are seeing some cracks, especially higher debt from individuals, corporations, and the government, and of course higher rates. It's possible to service that debt. So something on to watch. We've had this technical occurrence called with the yield curve. We've had an inverted yield curve. You might have noticed, even at the bank, if you're looking at CDs, you can get a better short-term CD than you can a long-term CD. Generally, in a normal economy, it should be kind of the opposite. The longer you're willing to invest, you're going to get a better rate. Short-term rates are higher than longer-term rates, and that's been almost an automatic for in modern history of a signal that we are heading toward. There's a slide on page 3 that Mark's got just talking about. When do you see that? It usually happens about 14 months after you've seen that inversion, and it's been 18 months. The longest it's been is 22 months, and the shortest. So Sage U believes that we probably most likely will see some type of recession. It might be kind of a shallow one. The Fed's got a very difficult job, as they're looking at past data and determine where it should be. And oftentimes, by the time you start to see the problems in the economy, they're playing catch up. Cut rates, it's usually they leave them high a little bit too long, and you see in general. So not a guarantee, but that's kind of what the numbers told us. Mark, if you go to page 5, 2 ahead. By the numbers, again, Pat said, higher rates are generally not good for stocks or bonds. The portfolio was down about 3% in the third quarter, although it kind of had a nice little rally the last couple of weeks. Seem to be giving a little bit back. Our belief is that the Fed will not raise rates again. There is a small chance of one more rate hike, 25 basis points. The market kind of took a breather last week. It's kind of made a consensus bet that would be done. And maybe the next move they make will be sometime next year, and then rates. Cutting rates is generally great. It's good for bonds and it's good for stocks. So we might see, potentially could see, as long as the economy stays stable, we might see next year. Just not really a good quarter. The only thing that was up was the energy sector. Sage U's outlook is on page 6. We kind of list things, the good, bad, the ugly, what's positive, neutral, and negative. We've got 3 good positives. Everybody working that wants to work, wage gains of about 4%, good consumer spending, and as we mentioned, surprisingly good GDP growth, which is expected to slow down this quarter. Negatively, we moved interest rates, and we were neutral on interest rates, thinking the Fed would have cut maybe by now, or at least signaled that they were going to be cut soon. It looks like it's going to be a while before the Fed cuts rates. Higher for longer is the terminology, and we see that as a negative eventually. It'll probably weigh on all those positives. Inflation is kind of the big thing, right? That's surrounding interest rates, and it's come down from 9, it's mid-3s. Fed wants to get it to 2%. They've been pretty adamant that they're going to keep rates high until they see inflation come to 2%. They may have to give a little bit and maybe compromise somewhere around 2.5%. How that works. We'll cover 7 if you're interested. Just a couple different time views of the global stock market. I kind of hit on some of these. International has been surprisingly strong over the last 12 months, though it's lagged this year. It's kind of held up with U.S. investments. We haven't seen much of that over a decade in the U.S. Larger companies are beating small. And then I'll finish at page 9, Mark. Yeah, not on our deck. That's that yield curve I talked about. Bottom of the chart, the blue line is where we were a year ago. The red line. The left side is short-term rates, so that would be reflected CD rates, money markets, and then as you go out longer, a lot of those 10-year rates are used when credit card companies use that to determine interest rates, banks use it for loan rates, and so on. You can see how you have short-term rates 5.25 higher than where we're seeing rates. Yeah, about 90% of the time when this occurrence happens, we do have some type of recession in the companies. You hear a lot of, even though economic data is pretty good, there's a fear that the Fed's going to break. Fixed income has not recovered. I think, historically bad last year, and have never put together 2 negative years in a row. So a lot of pressure on the bond market. We got 6-7 more weeks to this year, almost flat. So that has rallied a little bit. So look there. Any questions?
Allocation looks appropriate for all of it.
Yeah, I think so. I mean, we're roughly 45% fixed income, which has a decent shot of outperforming equities next year. So I think that's the yield on the portfolio was around. What's the yield, Pat, on the portfolio?
You're muted.
Yeah, so actually, I talked to Mark the other day. We think you're well positioned right now. We're going to taking our look at it early next year, but we think that the moves that we've made really have you kind of in a nice position as far as duration on the fixed income side. We pulled back a little bit from the indexing strategy, which again has a huge percentage of those mega cap stocks that have done so well this year. We have a little bit more defensive in nature, not a tremendous amount, but we did put a little bit more defensive there. And we added a couple of little asset classes, high yield, emerging market debt, to make those more meaningful. So we think you're well diversified in your position for what we both see, as Mark just stated, as we do see kind of a recession and a shallow downturn sometime first half of next year.
With the yield, I guess the yield on the portfolio is somewhere around 5% on the fixed income portion. If we get a couple cuts in rates.
Yeah. So limited duration fund is just around over 6% because you have corporates in there, and then the core fixed income's hanging around that 4.7%, 4.8%. So yeah, you're above 5% as far as yield in the portfolio, especially if you add in high yield and emerging market debt.
Taking a look at that at the beginning of the year, see where rates are going to be, maybe adjust the duration of that. But I think from a stock bond allocation, it's pretty solid and it's in line with what the actuaries tell us to do and how they're looking at it. So if we jump ahead, Mark, to page 17, Mark of our deck. I have some similar charts that Pat covered as far as the portfolio return. We look at it slightly different, so you'll see slightly different return numbers. Ours doesn't factor in cash flow, it's just allocation. But that's what we're seeing as well. The portfolio is beating the index, it's beating our peer group that we build similar size portfolios. It's doing so with appropriate risk and a really cost-conscious 12 basis points. Looks good from a high level. What we're looking at here on page 17 is SageView creates a score for all the actively managed funds. Give committees like this just an easier reference point, and 1 is the best score a fund could get. 100 is the worst. On average, the SEI funds are in the 19% now. It's very good, obviously. We're beating about 81% of these years. And you can see the detail on the next. If we look at the short duration fund, we compare the SEI fund with a few hundred competitors in that space, and they score based on our metrics better than 79%. So they're in the 21st. This is like a report card. It's basically how they score those 9 criteria, which are performance, risk-adjusted performance, consistency, expenses, how well they're tracked. The emerging market, yeah, that was a fund that was kind of an interesting one. It was on our watch list for its longer term performance. And I think we put it in the portfolio in 2021, and it's been performing really well. It's actually a contributor. It's a little bit of an erratic category because there's only a couple of competitors. For most categories, there's could be a couple thousand. Our score will fluctuate a little bit more, but we've been back in the second quartile. It's performing really well. It's been a good addition. We've taken that on our internal. Everything else scores well. We've got 3 funds, one fund that's an 11. We got 2 that are top decile. So really good scores. 19, we have 4 index funds in the plan. Again, very low cost. And we use a little bit more simplistic scoring for index funds, really based on expenses, how well it tracks its benchmark, and then any risk. All top quartile there. And then page 20 is our watch list. And we just removed the emerging markets deck. We're back in the second quartile pretty squarely, and we've done that for the last 2 consecutive. That was our update. Really, not much else. Anything you're talking about when you find pretty good, consistent.
Questions?
Well, I'm in New Hampshire, but I happen to be in New York 2 days ago, so I came here last night. Pretty easy. Snow in New Hampshire, though.
Yes.
I was telling Mark that the last 2 years I rented in the winter under URI, and so I had some flexibility. My kids are gone, and it's kind of nice. But I didn't do it this year. Couldn't come to an agreement on this. Good to see everybody.
This regular meeting schedule for 2024. Anybody see any issues with those dates? February 8th, May 9th, August 8th, and November. Entertain a motion to adopt that schedule.
Agreements on all. Alfinger, second.
Motion by Freeman, second by Alfinger. Any discussion? Not all in favor, say aye.
Aye.
Unanimously approved. And then our next meeting, any other business? If not, our next meeting is Thursday, February 8th, 2020. And I will entertain a motion to adjourn.
Alfinger, second.
Any discussion? Not all in favor, say aye. Aye. All right, we stand adjourned at 3:30.
Very fortunate.
Yeah. Just like I planned it.